forget the trade war for a moment. Tonight, we've got a whole new war to cover. I'm talking about the great chicken sandwich war of 2019, not to be confused with Australia's great emu war of 1932, which was won by the emus. For those of you who have the good fortune not to be on Twitter, man, were they killing me today? I mean, you believe it? Bring it on! The chicken sandwich war is a vicious duel to the death between Chick-Fil-A, the defending champion, and Cramer fave Popeyes, which I used to call Popeyes, but I've learned, the fabulous fried chicken chain that just rolled out their very first chicken sandwich earlier this month, which is impossible to get because it's so hot. In less than 2 weeks, the new Popeyes sandwich has become a viral sensation, fueled by their savvy use of social media. You've even got the Popeyes and Chick-fil-A accounts tweeting at each other, which is, holy cow, that is good marketing, even if it's a little freaky when brands pretend to be people. Still, you can see why this Popeye sandwich is caught on. This thing, I mean, just look at this thing. I mean, I'm talking about glorious. But we're not here to conduct a blind taste test or figure out who is the better chicken sandwich. This is Mad Money, not Mad Chicken, certainly not Mad Cow. So there's only one question we're interested in. How can you make money off the great chicken sandwich war? Okay, this gets a little tricky, frankly. You may not know this, but Chick-fil-A has actually become the third largest restaurant chain in America by sales. That's behind only McDonald's and Starbucks. And they're number one in the quick-serve chicken space. There's a good reason you don't know this, though, because Chick-fil-A is a privately held company, meaning there's no way for you to invest in its success. That's too bad, because the fundamentals, they're fabulous. So what about the other side? Popeyes appears to be getting a huge boost from their new chicken sandwich. According to management, this has been their biggest product launch in 30 years. And remember how much we followed Popeyes when they were public? Right? I mean, we knew it was a winner. According to the Washington Post taste test, they write about things other than trade war. Washington Post taste test, this thing is head and shoulders above the competition. Apparently, Chick-fil-A sandwich is, quote, always damp if you don't eat it immediately, end quote. And it's, quote, briny, but not crispy, end quote. These are not their words, not mine. Shake Shack has a good chicken sandwich, although the Washington Post says it has too much mayo. I mean, you could tell them to hold the mayo, but what do I know? As for this beautiful Popeyes chicken sandwich, Washington Post says it's the crunchiest, crispiest fast food chicken sandwich out there. It's also hefty with a great surface area than either of its competitors. Ooh, now I want to bite into this thing. Calories be damned. They continue. The bun is more buttery. Tell me more. The chicken is juicy, and the pickles are cut thicker. Hey, should I just eat this sandwich live on TV? Do you really want to watch me scarfing down a Popeyes chicken sandwich? Or maybe I'll save it for later. Hey, Regina, yes. We're going to need at least a dozen of these minimum.
Done.
Thank you very much. Good. We have a big staff. We have a big staff now. Anyway, the sandwich has been a huge hit for Popeyes. If you were following the story on Twitter, the commentary quickly transitioned from how great the sandwich was to how long the lines were getting, and then how some locations were running out. Hey, how about today? How about Thursday? No wonder. It's only $3.99. I mean, they're paying you. I mean, that's incredible value. But the amazing thing is that Popeyes hasn't even started advertising on TV yet. This is all viral marketing. And Analyst Stevens just raised his third-quarter same-store sales forecast for Popeyes from 3% up to 7%. 7% number could be conservative. So far, he's seen a high single-digit to low double-digit same-store sales increase based on channel checks. But it's still early in the quarter, so maybe demand slows down. There is, though, just one little problem. You can't invest directly in Popeyes anymore. 2 years ago, the company was acquired by Restaurant Brands. That's the conglomerate that owns Burger King and Tim Hortons. That's the classier Canadian version of Dunkin' Donuts. Restaurant Brands is an enormous company. Popeyes only makes up 12% of their stores and maybe 7% of their earnings. So while the stock could get a boost from the new chicken sandwich, it's never going to be a needle mover for Restaurant Brands. And that's unfortunate. I don't want you buying Restaurant Brands off this. For better or worse, if you buy Restaurant Brands, the aptly tickered QSR for quick serve restaurant, you're betting on Burger King. Now, the Kong has been good. There's no doubt about it. Stock's up roughly 47% for the year. They just launched their own meatless burger, the Impossible Whopper. I've had the Impossible Meat Burger. It is dynamite. And that's boosted traffic by nearly 20% at the locations where they're testing it out. And the last quarter was strong. Restaurant Brands is a fine company. But the stock isn't exactly cheap. It's roughly 25 times earnings, making it slightly more pricey than McDonald's and only a little cheaper than Starbucks. Unfortunately, the vast bulk of their growth is international, including some meaningful China exposure. They opened 140 Burger Kings, 140 in the PRC last year. And I've got to tell you, therefore, they got the mo. And I'm not going to tell you that you can't buy it, but you should know this. 3G. Yes, the real reason to avoid the stock has to do with 3G, the Brazilian private equity firm that bought Burger King nearly a decade ago and transformed it into restaurant brands we know today. 3G is now ringing the register in the substantial position. They own 41% of the company, and they've now brought that down to 36. Makes sense for them to take profits, especially after the hideous losses they've taken in Kraft Heinz. Holy cow, that's one of theirs. This thing's made these guys a fortune. But if they keep selling, it's going to eventually weigh on the stock. But again, I am not against buying restaurant brands. So you can't own Chick-Fil-A, and you can't own Popeyes as a pure play, only as part of a much larger conglomerate, which is a great company with potentially precarious stock. Maybe we need to think outside of the box here. Maybe the real takeaway here is that people just love chicken. They love chicken. And if that's the case, you don't need to invest in the chicken more directly. You need to buy an arms dealer. And when it comes to chicken, there's only one name you need to know, and that name is Tyson Foods. This big meat processor is a huge chicken business that accounts for 30% of their sales. Oh, go to the supermarket. You'll see, when you see chickens, you're going to see Tyson chickens. This stock has been a bit of a roller coaster after roaring higher in 2017. Stock got clubbed last year, real bruising. No Tyson has been hit that hard since the Mike Tyson got knocked out by Lennox Lewis, who my champion, by the way, on Celebrity Apprentice, when then businessman/TV star Donald Trump asked me who should go down the elevator and who shouldn't. Lately, though, Tyson Foods has come back with a vengeance, up more than 70% for the year. And even after that gain, I think, get this, I think it's got more room to run. First, though, a little mea culpa. I recommended the stock in 2017, not long after it broke down. Then I threw in the towel for when it dropped below 70. My track record, less than stellar. Hey, and people on Twitter, please go on and attack me as a buffoon and a chowderhead, because I would appreciate that. It makes me so happy. What you don't realize is that's what I live for and feed on. You clearly don't know me. Anyway, still, last year, Tyson was getting hit with some serious headwinds, like higher labor costs, higher transportation costs, and the new tariffs, of course. Then last September, CEO Tom Hayes, who we loved, stepped down out of nowhere for personal reasons. Longtime Tyson veteran Noel White taking over as successor. Since then, the stock indeed has caught fire, as you can see from the chart. Companies reported a series of consistently strong quarters. They're doubling down higher margin businesses like prepared foods. They've improved their execution. They've rolled out a plant-based beef alternative to compete with Impossible Meat, although it's got kind of a hybrid thing going. Their pork business is benefiting from African swine fever, which is killing pigs all over the world, especially in Asia, but not here. While Tyson's not totally immune to the trade war with China, they still get 88% of their sales from the U.S. Oh, and President Trump just agreed to a trade deal with Japan over the weekend that nobody's talking about that will open up the Japanese markets to more American beef and pork exports. It's actually quite a big deal. Plus, we know millennials love protein. I mean, Tyson's all protein. Best of all, even after this magnificent rebound, the stock is still cheap. Now, this is only 13 times earnings as opposed to restaurant brands. Bottom line, when you see all these people lined up outside Popeyes waiting for a bite of their terrific new chicken sandwich, you should buy the biggest arms dealer in chicken world. Yes, Tyson Foods. Whether Chick-Fil-A or Popeyes wins the chicken wars, Tyson will always come out ahead. We're going to start the questioning with Keith in Minnesota. Keith!
Hey, Jim, it's Keith. I have a position on Cisco, SYY. Just wondering what your opinion is. They had a
I like both Cisco's.
Last quarter.
I like both Cisco's. CSCO, Chuck Robbins. Okay, the quarter wasn't perfect, but it was all right. And then Cisco, SYY, the one that you own, wow, that was a shoot-the-lights-out quarter. I get to interview Nelson Peltz in September at Delivering Alpha, and we may have to try to bring that up just momentarily. I'm really talking much more, of course, about Procter & Gamble and David Taylor. But now let's remember, as we await a supreme leader to emerge in this clucking chicken sandwich war, I'm recommending you go right to the source and add Tyson Foods to your plate. Stock's run a lot this year, but hey, it's a bargain versus, say, Restaurant Brands, which owns Popeyes, but I'm not against that one either. Much more Mad Money at. Is Elanco barking up the wrong tree when it comes to its purchase of Bayer's animal health business? I'm giving my take on the company's decision to pounce. Then, how this market's pajama party could be impacting your portfolio's potential. And all your calls, rapid fire, in tonight's edition of Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.